All right, everyone, buckle up, because today we are diving headfirst into Celcius Holdings, Inc. You know CELH, the energy drink company. Everyone's talking about them. So we dug into a recent stock analysis to see if all the hype is worth buying into.
Yeah, I mean, this company's been absolutely exploding recently, so I'm definitely interested to see what's in the
Yeah,
analysis.
me too. Celsius, they're the company behind all those functional energy drinks and liquid supplements that seem to be everywhere these days, right?
Yeah, you see them everywhere now.
Founded back in 2004, headquartered in Florida, and now a global player. But, you know, the question is this the kind of stock that could bring some heat to your portfolio?
Yeah.
Hopefully in a good way, right?
Right, exactly. That's what we need to figure out. And one thing that immediately jumps out is this. Their 5-year growth is insane, like over 3,000%.
3,000. Okay, yeah, that'll definitely get your attention. So let's get into it. What's fueling this rocket ship?
Well, their revenue tells a pretty compelling story. In 2021, they did $653.6 million in revenue, which isn't anything to sneeze at. But get this, as of today, that number has more than doubled to $1.41 billion.
Wow, that's incredible.
Yeah, and analysts are predicting that they're on track for another, get this, 25% growth by next year.
So almost 30% growth on top of what they're already doing.
Yeah, their projected EPS growth is a whopping 29.54%.
That's wild. Okay, so we're dealing with some serious growth here, but as always, the question is it built on a solid foundation? What about their financial health?
Well, that's where it gets really interesting, because those numbers are huge. But sometimes when you see huge growth like that, it's built on shaky ground, right? But their financials are surprisingly strong. Like their current ratio is 4.17, which means that they basically have 4 times the assets on hand to cover their short-term liabilities.
Wow, so they're not hurting for cash.
No, not at all. And their debt-to-equity ratio, try 0.01. They're practically debt-free.
So basically, on top of everything else, they're sitting on a mountain of cash.
Pretty much, yeah. They've got almost 900 million in cash and a free cash flow of just under 270 million.
Okay, so this isn't just growth, it's smart, profitable growth. But that brings us to the valuations because no company is perfect, right?
Right.
And I have to admit, when I see a PE ratio over 45 and a price to book at 28, those numbers make me a little uneasy.
Yeah, I mean, it's true. Those are really high. But you have to remember what we're looking at here. This is a company that's on an absolute tear. So the question is, can they maintain this momentum? If they can, then those valuations might be justified.
That's a big if, though.
It is, but there seems to be a lot of very smart money that's betting on them.
That's true. We are seeing significant institutional investment. Over 65% of shares are held by institutions,
And it's not just institutions. Insider holdings are strong too, over 40%.
which is a good sign, right? If the people who know the company best are holding onto their stock, that means they believe in the company's future.
Right, exactly. It's definitely something to consider.
Absolutely.
Yeah.
Because it's not just hype. They're making money. Their margins look great.
Yeah.
Gross margin of 49.62%, operating margin of 21.55%, and a net profit margin of 15.23%.
Yeah, you don't see numbers like that every day.
But what really caught my eye is their return on equity, which is over 91%.
Which is a great indicator that they're very efficient at turning equity into profit. And this is where I think you really start to see the power of their business model because they rely so heavily on direct-to-consumer sales. By basically cutting out the middleman, they get to keep a much larger portion of each sale.
That makes sense. It's definitely a leaner model. So they're growing, they're profitable, their financials are rock solid. I'm not surprised that analysts are giving them a strong buy rating. The price target is $77.50, which is almost double where it is now.
That's a pretty significant upside. But, and I always hate to be the voice of doom here, but we do have to remember that past performance isn't necessarily an indicator of future returns.
Right, of course.
I mean, remember Bang Energy? They were on top of the world and then they crashed and burned. Now, I'm not saying that's going to happen to Celsius, but it is a good reminder that things can change quickly.
Yeah, and it shows that even a company with great products can still stumble. So what's the takeaway here? Well, with Celcius Holdings, we're looking at a company with booming growth, solid financials, and tons of analysts who believe in their future.
Really, they check a lot of boxes.
But those valuations are still high, so whether or not you invest depends on your personal risk tolerance.
Exactly. That's the question everyone needs to ask themselves. How much risk are you comfortable with? Celsius has the potential to be a rocket ship, but you need to decide if you're strapped in and ready for the ride.
Well said. And that about wraps things up for our deep dive on Celcius Holdings. Don't forget to like and subscribe so you don't miss any of our future deep dives. Until next time.